Chinese equities have surged over the past 3 weeks, shaking off years of underperformance thanks to the surprise stimulus measures by the government, which is aimed at reviving its sagging economy.
It's been one of the most exciting weeks for investors all year. Hong Kong stocks surged for a third week straight, with a 3 trillion market rally driven by China's stimulus injection efforts.
The Chinese stocks recorded their best single-day rally in 16 years after the country announced more stimulus measures amid an economic downturn.
You get these opportunities. I'll give you some internal statistics. 97% of the constituents of the CSI 300 are making 20-day highs. 100% of the constituents are above their 20-day moving average. This is unabashed momentum.
The biggest casualty of this rally has been the Indian market, which has weakened of late after foreign investors pulled money out of Indian stocks to reinvest in China. Just to put things in perspective, Indian equities for years have been beneficiaries of China's lagging performance. Now, the question on everybody's mind is this the beginning of China's outperformance compared to India? Will Chinese stocks build on their recent gains, or is this just another false start? It's Friday, October 11th. I'm Nishanth Vasudevan, Markets Editor at the Economic Times and your host for today. Welcome to the Morning Brief. Joining me today to explore this topic is Manish Bhandari, CEO and fund manager at Vallum Capital Advisors. With over 2 decades of experience in equities, Manish is a seasoned portfolio manager with strong insights into what's happening in India and elsewhere. Manish, welcome to the Morning Brief.
Hi, thank you for hosting me, Nishanth.
Manish, everybody's been wanting to know about what is happening in China these days. If you look at Chinese stock markets, they are considered cheap. In fact, it is one of the cheapest stock markets in the world. And because of that, many value investors have bought into China a couple of times earlier this year also. But then the rally fizzled out.
The slow pace of Beijing stimulus efforts and disappointing holiday spending figures, that has now caused traders to lose faith in the Chinese stock market.
After gaining as much as 11% at the open, the CSI has given up about half its gains already. The NDRC session, as we said.
The question that is there in everybody's mind is that will it be different this time?
So, Nishanth, if you go back into history, there are close to 5 rallies which has happened from 2005 onwards. The first rally of 2005 did stayed for 22 months, and the MSCI China did 230%, and then they'd fall off the cliff. The second rally happened in 2008 for a duration of 9 months, and again the MSCI was up 81%. 2015, another 8 months of rally and 33%. And 2017, 13 months of rally, 73%. And then brief rally in 2022 also. If you ask me whether this rally is also destined to fail, answer is no. The government has taken many steps in the last couple of years to make this equity market lot more, ring-fenced from the problems which Chinese equity market faced, and which was a very weak trust in the Chinese equities. And that weak trust was also because of the weak enforcement on the Chinese stocks and the stock-related issues. I see very incremental positive news coming out of China when I see that what they want to do towards the equity market. And to me, it looks like a long, sustainable rally. China is a beaten down because they have not produced the shareholder returns for years together, because the job creation was the first target they had. So they did industrialization left, right, and center to create companies which can provide you the jobs and not the shareholder returns. Now China is changing significantly. China is rebalancing. There is an overcapacity in the world. China is technologically advanced. There's no second thought about it. And when I see those rebalancing effect, then I see that the China will create a service industry, and one of the roads to the service industry will also flow through the stock market investors.
Manish, the basic question that our listeners would have is that why should the strength of Chinese equities matter so much to India? Now, India's investors recognize India as one of the fastest growing economies in the world, while China is facing some sort of an economic crisis, especially with its real estate going through some kind of a pain, while the consumer confidence is declining. So, what explains this entire India versus China kind of relation that a lot of people are talking about, and what is also playing out in the past few days?
So usually, Nishant, for these issues, it's a week happens in a decade. So a few days is no barometer that what you want to see in a outcome as an investor when you are investing in any specific country as an investment theme. Now, you clearly mentioned out that there is some wobbliness in the economic data point of China. Absolutely, yes. China was built on the suppression of the savings of the investors and the suppression of the savings of the fixed deposit shareholders. And that created a negative interest rate for long period of time. And that long period of time also helped in creation of the industrial capacities left, right, and center. And one of the biggest beneficiaries in this whole process was the real estate sector. But look at this. Usually people mistook a word recession with an economic slowdown or so. China is going through a slowdown, but not through a recession. A recession is a 2 consecutive quarter of negative GDP as a contraction in the GDP. If I have to look at the Chinese companies listed on the Chinese stock exchange and except the real estate and the financial services sector, most of these companies from 2019 to 2024 would have grown for 4 years, would have grown at 8% to 12% or 15% or so in a corridor of this. So China is growing.
Manish, could you elaborate that a little more? What does this mean for investors in India and China?
Any asset in the global which is offered itself to the global investors does offer itself for a competing resources. So asset manager sitting outside India would always have an option to invest either in China or in India. And it's rightfully so that India became a beneficiary of China not doing well as a shareholder value creation for last 1 decade. And that's explained in the return differential between India and China. India and China do compete from the ETFs on the exchange indexes. The weightages of the China went down substantially. The last 10-year returns of Indian MSCI India is close to 166% or so. And for 10-year return for the China is 54%. And as you know, that you have the BYDs and a host of technological advanced companies in China, which has not been the case in India. So there's a competition for allocation of the resources. India has done remarkably well in the last 3 years. But one thing has changed, that the over financialization of India has pushed the valuation, which is a metrics of EV by EBITDA multiple or price to book or so, to significantly higher levels, versus the return on equity of Indian companies as a consolidated level is close to 15%, and that is more or less has remained same in the last 3.5 years time frame. So with that lens, the whether India could go up again from a return on equity of 15% to 17% or so, versus China, which is at 10.5% return on equity, and it could move to 13, 12, 13% when the fundamentally a consolidation phase is coming in China, where the government has decided that they will consolidate most of the industries and the capacity what they have built. It's an overbuilt capacity, and they are consolidating those capacity, which ideally, with the next 3-year horizon, should produce a better shareholder returns versus a consolidated structure like India, where the steel consolidation happened and many other consolidation happened.
No, at the same time, there are still a lot of these influential global funds that continue to think that India's bull market, the current bull market that we are seeing, remains structural, while the rally that we have seen in China could be short-lived because at best, the allocation to China is tactical. Do you agree with that argument?
Not at all. I think China can never be a tactical position. The day you decide that the China is pushing sustainable value creation for the shareholder, that becomes a sustainable investment story, and that becomes a very long-term structural story. Now, the argument can always be that China is aging. China doesn't have the demographic dividend like India has. And same arguments would cut across both the ways, that India doesn't create a job. And this time it was one of the important things on the agenda while the voters were voting for the central government election. So it is not an easy. It could be it's a policy dividend, or the demographic dividend could be a nightmare also. And second thing is, by the time the China will start producing the returns and you will see all the measures coming in on a one force, you won't get the stock market at the same price. The market and the pricing will change substantially. I must give you one very interesting data point.
Right.
The Chinese central bank opened a swap line of close to $800 billion renminbi. And out of that, this $800 billion renminbi swap line is for two purposes. One, for the refinancing, where they will take the stocks as a collateral from the institutional investors. They want to encourage buybacks. The Chinese buyback is maybe, I think, not even 1/10, less than 1/10 of the US buyback system. So when I see the capital market friendly measures, which has already happened in India, and they are quite at advanced level, I see a work in progress in China. So it is up to an investor to believe that they want to be where the work in progress is there, or they want to get invested when all the things are already in place, and they want to buy this story when it's 100% up or 150% up.
So basically, you're saying that, the fizzling out of the rally that we have seen probably in the past 2 days, it is too early to conclude that, this is another one of those false starts that we've seen in the past 1 year or so.
Yeah, absolutely. When you are making those strategic calls, you are taking a 3 to 5 year views. You are looking at the incremental changes and incremental data points, and then you are taking those calls. You're not taking call that you get excited that you have made a 20% in 2 weeks. There are times when nothing happens for a decade, and there are weeks when the decade happens.
How do you think it will play out in the foreseeable future? Premium India or cheap China?
You just reminded me, as the Diwali is coming, so the cheap lights will be all over the places for us to say how to lit our houses, which has been a point of discussion. So, yeah, it is a cheap stock market. Anyone who has followed China and has visited China on many occasions would be in a position to really give us an idea. I think the best way to look at it is a framework. What you run as an investor is its value for money is not there or not. So you have to always ask yourself in anything what you do, is there a value for money? Today, China offers you, as a 5-year or a 3-year investor, offers you a value for money today. And India may not on a larger basket offers you, pocket does offer you a solid value for money. I'm not making a case for India that one should exit India or invest there. But I'm saying that there are pockets which are very expensive. There are pockets which are still there is a value in India, but it's the whole market is not offering you a compelling value or a screaming value.
Like China does.
No, China, you'll always go and invest in the pockets.
Yeah.
You will not. I would not go in China and buy an industrial capacity today till the consolidation is over. I will may go and buy a consumption story in China. I will go and buy something else. You may go and buy, fintech companies in China. So you have to pick and choose what you want to buy from a top-down perspective. Not industrial companies anymore at the moment.
Manish, coming specific to India, the Indian markets as such, the buy on dip strategy has worked very well in the past maybe 4 or 5 years. I mean, corrections have been shallow. Every time you kind of buy on dips, it has only rewarded you well, because the markets have obviously gone up every time after a dip. What about this time? Do you think the buy on dip strategy will continue to work even after the ongoing correction that we are seeing?
It all depends upon how back you are seeing. The buy on dip has been rewarding from 2020 onwards till now, which is a 3.5-year time frame. If you did that buy on dip in 2018, after the crisis which happened for an intermediate period on the small and mid caps, for 2 years, you didn't make any returns. Yeah. So it all depends upon how far you want to see. That strategy works under a certain directional view market. If the market has to get into a time value correction method, then we are talking about that this buy on strategy will not work, because you see the time frame between 2009 to 2013, the market gave you a 0 returns, BSC, midcap gave you minus 9% return, and there was stock picking which was doing well. So whether individual investor naive enough, sitting very far away from the capital markets, can do the right stock picking, or he will go and buy the indices. Indices work when the directional is right and the whole economy is doing very well, unidirectionally. If the market has to move into a dispersion and only the select companies or select sectors have to do well, it's not a so easy task.
If investors in India want to bet on China and let's say its potential market recovery, how should they go about it, directly or indirectly, sitting in India?
See, all always depend upon how conversant you are with that market. You have few funds which are being offered through the mutual fund routes in India to bet on a larger shape. People can use a global broker and bet on the stocks themselves. There are few brokers who offer these kind of services. There will be something in a gift city which would be compelling enough to make a bet on those companies through those structures. I'm not too sure whether a manager can make a wrong choice of investing in a wrong set of companies, a wrong set of sectors or so. So investors need to do their own due diligences. For a patient and a naive investor who is not so sophisticated financially, I think the mutual fund routes which are offering these kind of offerings in the global markets can be an interesting aspect to look forward to.
That brings us to the end of today's episode. The key takeaway is China's recent rally could have some staying power. While India's long-term economic prospects remain strong, its stock market may face some short-term challenges if China regains investor attention. Thank you once again, Manish, for joining us and sharing your valuable insights. And a big thank you to our listeners. This episode was produced by Vinay Joshi and sound designed by Rajas Nayak. The Morning Brief drops every Tuesday, Thursday and Friday on your preferred audio platform. So be sure to tune in. This is your host, Nishanth Vasudevan, signing off. Have a great weekend.